Good morning, all. I want to thank you for joining us for the April 2023 edition of the monthly CAPIS research briefing. My name is John Lance, and I'll be the host for this morning's presentation. If you were able to join us last month, you recall Brendan Walsh and John Fagan from Markets Policy Partners discussed topics ranging from inflation and the Fed to the very timely Silicon Valley Bank and its impact on the market. Today, we have the pleasure of having John Kosar, the Chief Market Strategist from Asbury Research, joining us. John's been in the industry for over 40 years, with his first 17 years on the trading floor of the Chicago Mercantile Exchange. Asbury Research was founded in 2005 as a data-driven research provider to understand the market, what it's doing, and how and when to be involved. They've built several successful models over the years that I'm sure John will discuss today. In addition to sharing their data-driven perspective, John will be taking questions at the conclusion of this presentation. Please use the Q&A icon at the bottom of your screen to enter questions. And finally, before I turn it over to John, if you're interested in Asbury's research after the call, I encourage you to check out his website at asburyresearch.com and reach out to get more information about their offerings. With that, I'll go ahead and turn it over to John.
Thanks very much for the intro, and hello everyone. Good morning. This is my first opportunity to speak to you all, so thank you for the invite, and let's begin. Interesting times, by the way. I think we could be on the verge of I believe we're on the verge of a very significant move in the market, and it looks like that move is going to be higher. So what I'm going to do is I'm going to begin just with a couple of charts, couple of selected charts, curated charts from some of our reports recently, just to kind of give you an overview, like a starting point of where we think the market is, levels to look for, indexes to look for, metrics to pay attention to, and then we're just going to walk through 5 of our models to show you where those models are. And I think by looking at those first couple of charts, we'll give you a little context where those models are going to be a little more specific in terms of timing, in terms of where to be invested and what to avoid. So this is just a little bit about me. This is my 42nd or 43rd year in the business. John had mentioned that I started my career on the floor of the CME, Chicago Mercantile Exchange, back in 1980, knowing absolutely zero about markets. I fell in love with it immediately and found out very quickly that the guys back then, there was no computers on the floor. Back when I started, the guys that seemed to be making the most money were the guys that were walking around with the point and figure charts, the pencils, and always walking with their heads down. Those were the guys that seemed to be the most successful. I was drawn to that data-driven, price-driven, momentum-driven part of the market, rather than the more esoteric parts of the market, including economics and fundamentals. This seemed to kind of hit the rubber hit the road on this particular discipline a little bit more. What we do, early in my career, I did a lot of forecasting. When you're a young guy, you want to get noticed. That's how you get on television. That's how you get quoted in the journal. The older I get, the more that I look at this, the more everything is based on data. The fundamentals, the economics, quantitative inputs, technical inputs, they all meet at the end of the race, so to speak, but very, very different in terms of how they present themselves to investors. And typically the data-driven stuff is going to get on a trend that's just beginning sooner than anything else in my experience. So we get a chance to get on these trends sooner, and then we'll leave it to the guys on financial television to tell us why the move is happening, when it's a third to a half over. There's 2 basic questions I think that most investors have. I think people make this really complex, and we try to simplify it. There's 2 things that most investors want to know. Should I be invested here? How much? Should I be partially invested, mostly invested? And then the second question is, what do I buy? Because the nirvana is to get the trend right, to get on the market when it's going higher, stay with the trend for most of the trend's entirety, and then be in places where you can outperform. So if you can get the trend right and you can outperform a little bit, that's as good as it gets. And that's what our models do. We help our clients when it's time to be aggressive. Risk on is what we call that. When it's time to be defensive, protecting capital. If you can protect your capital when the market does throw you a bad year like it did last year, if you can miss some of that and reallocate those funds underneath the market, from where you moved out of the way, or maybe you shifted to more defensive assets. I mean, that's really how that's how you boost portfolios quickly. What parts of the U.S. financial landscape are doing the best? Which sectors and industry groups to buy? We look at asset flows and other metrics to determine that. We look at global markets, and then we look at a lot of ETFs. Sometimes when the market's going down, there's other places to make money. Last year, there was really great opportunities in South America in the first 3-4 months of the year, Western Europe in the last quarter of last year and extending into this year. And then we also look at a lot of ETFs that have to do with the commodity space. We've been in and out of gold twice so far this year and have made money both times. So I like to look at a lot of different parts of the market. It helps me to understand the bigger picture better. Our data-driven models, we're going to go through these one by one. We have a risk management model, a wealth preservation, sector selection, domestic and global asset allocation models. And then finally, we have a model that we're not going to get to today, but it scans ETFs for 3 things: trend, positive trend, relative outperformance versus the S&P 500, and positive asset flows that are moving into that ETF, which is really the fuel that drives a trend. I want to begin just kind of with an overview of where we think the market is. And that is the S&P 500 has been sitting on a pretty important support. I'm actually looking up at the screen right now. The S&P 500 right here, 4,100, 4,000 is a big level. Just in terms of trend, the S&P 500 broke out on January 23rd of this year. It spent the month of March backing into that support level that it broke out of. It's about 3,900, 3,950. It was there all of March, right? This has been a really boring market, but that boringness, let's call it, in March actually set up a base for the market. The target on that is 4,250. We really need to get up above 4,140. If we can get up above 4,140, let's call it 4,150, that should take us right to 4,250 to 4,300. And by then, that's going to confirm what I see as opportunity here to be able to buy the market at with relatively low risk, with the potential of the market moving significantly higher this quarter and possibly through the summer. So we're looking at this as one of opportunity. So now that we know the market has a base here, there's some other indicators we're looking at. Investor sentiment has been very negative here for a couple of months. That usually implies a bottom. Standard deviation, we had an extreme of standard deviation back in March that historically over the past 10 years has been indicative of market bottoms. I don't have these charts here. I thought I had them on this the report that we're looking at today. I will send those to you. If you're interested, contact us. You can go to asburyresearch.com and go to the contact tab. I will send you those charts. But there's a lot of infrastructure here that suggests that this is an opportunity to buy. So the first thing that we want to do is we want to see what the condition of the market is internally. I built the Asbury 6 5-6 years ago because the market's changed. Anyone that's in the market every day knows that the daily volatility of the market is different than it was a decade ago. And maybe 5 or 6 years ago is when I really noticed that I needed to change my approach. So if all you're doing is looking at the S&P 500 every day with a couple of indicators, be it volume or whatever it might be, you're going to be chasing your tail a lot. The market's up 70 today, it's down 50 tomorrow. All of this algorithmic trading that goes on during the day, all of the computerized trading, it's kind of taken the place of the locals that used to trade in the pit when I was down on the trading floor in the 80s and 90s. They're trying to push the market to places where it forces investors out of their position, then it runs it the other way, forces you to get back in. So we built the Asbury 6. I back tested my favorite tactical tools throughout my career, and I came up with 6 indicators that act for the market like when you go to the doctor's office for your annual checkup. The doctor may have a visual impression of what your health might be when he sees you come in the door, but once he sits you on the table, starts to check your pulse, your heart, and your heart and lungs, your blood pressure, and reflexes, that little battery of tests he does, he gets a lot more under the hood, accurate indication of what your baseline health is. That's what the Asbury 6 does for the stock market. So here we go. Here's that chart real quick that I wanted to show you. This is the S&P 500, and we're going to get back to the Asbury 6 in just a moment. So here's this 4136 area that we're hovering at right now. It's the trend line drawn from the August highs that we made last year. If we break through there, that should take us right to 4,200. If we get through 4,200, the next level is 4,250 to 4,300, and you've got this big support kind of area here. This is a 200-day moving average here in orange. So this is a base to me, and this suggests that we can go a lot higher. This is the SOX index. This is bigger picture, and this is important to me. This big sweeping curving bottom here is actually a chart pattern. The SOX index, as you know, is the Philex semiconductor index. I call the Philex semi index the tip of the spear. The SOX typically outperforms technology. Technology typically outperforms the broad market. Not all the time. There are no all the times in the stock market, but generally speaking, I want to see what the SOX is doing to get an indication of kind of where investors are looking to put some money to work in a higher beta, more of a risky index. And what we have is a breakout here again on January the 23rd from this big bottom that started back in the summertime of last year. Here's the July lows, the October lows, a third important low here at the end of Dece of last year. This breakout targets 3750 as long as we stay up above this 200-day moving average, which is it's major trend proxy at 2764. So do I look at this and say, oh, I'm going to buy the SOX today and put it in the bank because we're going to 3750? I don't do that, but this gives me some context. Once we get into the models, which is going to be shortly, it gives me some context. Okay, I've got these models tactically telling me to do this. I want to make sure that the model signals that I'm getting, I'm trading in the direction of the bigger landscape. And that's what we're looking at now. There's one more that I mentioned. My slides were a little bit out of sequence, but this is what I wanted to show you also. This is the percentage of NYSE stocks trading above their 40-day moving average. So this is a breadth indicator. So you can see as of the 23rd of March, we're coming from this extreme in weak breadth. We had a similar one in September, another bottom. We had another one in June, another bottom. There's a standard deviation version of this that basically shows the same thing, that we made an important bottom at the end of March. So here's our Asbury 6 metric. The Asbury 6 is updated every day, and there are 6 indicators that tell me the internal health of the market, just like the metaphor when you go to the doctor's office. We look at the monthly rate of change, relative performance between equity prices versus high yield bond prices, investor asset flows, corporate bond spreads, trading volume, and market breadth, stuff that can't be influenced by the day-to-day gyrations of the S&P 500 or the stock market price in general. It's kind of a lie detector type situation for us in the markets. You can see that this metric has been green or positive since the end of March. You could see it caught the bottom in October, on October the 18th. It caught the bottom, it caught the June bottom back in July. These are the green arrows I'm circling here, if you can see my mouse. And then it caught the peak here. It caught the initial breakdown at the middle of January of last year. So last year, our models did quite well because we were underinvested, or we were invested in defensive places really from the beginning of last year. So this is the model as it stands right now through 2 days ago. It's still all green. All of the 6 metrics in here: rate of change, relative performance, investor asset flows, corporate bond spreads, trading volume, and market breadth. They are all currently positive. That's why they're green. 4 or more of these metrics in one direction indicate a tactical bias. So the tactical bias is up, and you can look at the dates here, and you can see the dates that all of these turned to positive from negative or red. All these cells were negative or red from really the latter part of February and turned green. You can see really 3rd week of March is when it started. Everything is green now. So what does that mean? It means the patient is healthy. And even if the market jumps up 20 today and down 50 tomorrow, I'm focusing on this. This keeps me from getting faked out. This keeps me from getting pushed out of a good idea, a profitable position. And as you know, by looking at those first 3 charts, we've got an upward bias based on kind of the overall landscape of the market. So this tells us this is time to start to be adding some risk to the market. The correction protection model is kind of the bookend for the Asbury 6. The Asbury 6 is a dimmer switch. The CPM is just a regular light switch. Either you're off or you're on. 10, 12 years ago, I was asked by a lot of RIA business that we have, a lot of money managers, can you build us an indicator that allows older, wealthier, and more risk-averse investors to participate in the market, to stay reasonably close to what the S&P is doing, but with a lot less risk, a lot less volatility? Can you build something? That was the genesis of CPM. CPM is basically a defensive model that can be turned into an offensive model if we use some leverage with it. Here's the CPM. Again, it's either risk on or risk off. These are the signals for CPM over the past 15, 16 months here. This started back in January of 2022. You could see we went to risk off on January 16th, entered back on March 18th, moved back to risk off on April the 12th, cut this giant move down. It caught the bottom back in July, back in October, and we don't expect, this is a tool. So a lot of our managers use this in different ways. They just may be looking at the risk off arrows, which have pretty much caught every top that we had last year, every tactical top that we had last year, and use those for indications where they may want to tighten their stops on existing positions. Maybe move into sectors that are more defensively oriented than offensive, maybe move to staples. And we have a model that actually does that we're going to get to in a moment. But that's the purpose of CPM. So the strength of this thing is we back tested CPM over the past 12 years through the end of last year. And what we have here is, on average, it's underperformed the S&P 500 by 2% a year, but it's done that with a beta of 0.44 versus 1, of course, for the S&P. Maximum drawdown only 15% versus 34% for the S&P. Look at the standard deviation here, goes to 9% from 14.4. We've got a better Sharpe ratio, better Sortino ratio. Generally, it accomplished what I wanted it to accomplish. Playing the game, getting close to the bogey, which is the S&P 500 for us, with a lot less risk. So I backed this and I said, what happens if we put some of that beta back in here by using a leveraged ETF? And I did this more as an exercise so I can understand my own model better, but we used the same signals with a 2 times leveraged ETF, SSO, which is 2 times the SPY, basically, it's 2 times SPY. So now it brings our beta up to 0.87, still a little bit less than the S&P, brings our max drawdown to, let's call it 30, still a touch less than 34. Our standard deviation goes up a few percentage points. Sharpe stays about the same, but now we're outperforming the S&P by 5.7% a year with a lot more outperformance years. So that's our other tactical model that tells us when to be invested. It has been risk on since March the 31st. So the next question is, what do I buy? So this particular model is called SEEF. SEEF stands for Sector ETF Asset Flows. I built the model because 10 years ago, I had a very good model that I built and I used all the time for finding the sectors that were outperforming, finding the best sectors for sector rotation. 10 years ago, normal sector rotation, anecdotally, it would give you a quarter or two of outperformance. Everything sped up. And again, I really attribute this. There's a lot more computers trading out there. There's a lot more day-to-day volatility. It's shortened up all of the trends, even in sector rotation. So what used to be a 1 to 2 quarter trend on average is now 6 to 8 weeks. And what happened is by the time my old model saw these in terms of relative performance, they were half over. I need to get quicker. I need to get more agile. So I built this model, which measures the asset flows moving around the 11 sector spiders in 3 different time frames: trading, tactical, and strategic. And then it ranks them according to the best velocity of assets going into a certain sector in a certain time period. You can see they're ranked from 1 to 11 here. The best 2 are highlighted in green. Last week, the biggest acceleration of assets in went into communication services and went into financials. And then the worst 2, which was assets out, were healthcare, number 10, technology, number 11. So then we do this in tactical, which is 1 month. Then we do this in strategic, which is 1 quarter. Then we add those scores up. So anything between 3 and 15, 3 would be the best that you can get. You see, we got a 4 out of communication services here. It was number 1 in 2 time frames and number 2 in the 3rd, strategic. So then those that are 3 to 15 are favored. Those between 16 and 24 are neutral. And then those that we want to avoid are in that last group of 25 to 33, which right now is real estate, healthcare, and industrials. So we back tested this model. Well, before we get to the back test, let's have a look here. This is the chart version of this. So you can see this is updated once a week and incorporates the data from the previous week. So you can see from best to worst how all of these scores are. And then we have our SEEF model itself adds some protective money management tools, and our SEEF model signals are highlighted in green. It's an extra layer that it has to go through, the model has to go through to allow for risk management. So right now, those 2 are communication services and technology. That's where we see the money going. That's where we want to go to. And here they are. Here's XLK technology. You can see since the model went to a favored on XLK, it's risen by 5%, underperformed the S&P so far by 1%. Here's XLC. Our model identified it as an opportunity on March 27th, up 5%. Again, underperforming a little bit. We'll see what happens to this in the future. And here's the numbers on this. And this is really attracting me. Over the past 10 quarters, it's outperformed the S&P by 8 of them. All of the green ones are outperformers, and all of the 2 red ones are underperformers. We actually underperformed in the first quarter. So we're 8 out of the past 11 quarters outperforming. In 2022, we outperformed by 12%. What I like about this is the stats are still pretty stable here. The beta is 0.91, a little less than the S&P, kind of right there. Maximum drawdown, 22.5% during that period, a little less than the 25.4 for the S&P 500. And you can see the annualized total return is quite a bit better. We gave a little bit back this past quarter. So again, this is what I strive for. This is what is fun for me. I look to try to play the game smarter with limited risk and try to watch the money moving around the board to find the best opportunities. And here's just another look at that model. The SEEF model for the past 10 quarters is in green, and the S&P 500 is in blue. You could see the little wiggles are the same because it's trading a subset of the S&P, but it's finding the places where the money is going and following those. Here's another one of our models. It's the CARP model. The CA stands for cross asset. So when we're risk on, or if you're a money manager, you still have to be invested when the market's going down like last year. So what this does is this looks at 8 for equities and 3 for fixed income relative performance comparisons. And it finds those that are outperforming in multiple categories. Here's large cap, outperforming small cap in multiple categories. It gives you the dates that each of these outperformance trends started. And that's another way that once we know we're risk on, our CPM is risk on, our Asbury 6 is green, and the bigger picture for us looks constructive for the market to make a good move. This is where we determine what parts of the market do we want to be in to try to see if we could capture relative outperformance, assuming that we've got the trend right. And again, last year, even though the market was going down, it had us in value stocks. It had us in low volatility stocks, and it had us in the Dow for most of the year. So for those that are managing money and just can't go to cash and fold their arms, it also tells you where the outperformance is even in a bear market. So here's a couple of the current picks, so to speak, for CARP growth here. It showed up on our model on January the 26th. Outright, it's up 6%, and it's outperformed value by 9% during that period. So we're picking up a little bit on both sides. Here's large cap versus small. Large cap, it showed up on our model on March the 9th. Large cap has risen by 6% outright, and it's outperformed small cap by 8%. So these little distinctions of getting the trend right, of getting the big picture right, and then finding the places where the outperformance is, to me, those are the 3 legs of the bar stool. Here's another model that uses the same concept. We're looking for relative performance in multiple time frames. This is our US versus the world model, global equities relative performance. You can see here we have 24 foreign markets here. They were all measured on a relative strength or relative performance basis versus SPY. This helps us to see where the value is. Last year, when we were in a bear market, from January to April, Chile, Peru, and Brazil killed it. The model picked those up early at the latter part of January and kept us in those trades through the first quarter. Now the trend has gone to Western Europe since September or October of last year. And you can see of these, we've got Italy, Switzerland, Spain, France, UK, and Eurozone. All of 7, I think, out of the 11 are all from Western Europe. And now we're starting to get some strength showing up in South America. And we got Chile here, we have Peru, we have Brazil. So those are opportunities overseas for those that like to put a little bit of equity in international markets, especially when our markets are dull, as ours has been sideways since the latter part of last year. This is another way to find some alpha. Here's 2 of those that have been in existence according to the US versus the world model for the longest period of time. The signal came on October 10th. France has outperformed SPY, EWQs, the ETF. France has outperformed SPY by 26%. Since then, it caught this about 3 weeks before it actually got up above its 200-day moving average to indicate a major bullish trend change. But outright, since October 10th, it's risen by 44%. A lot of value here. Here's Spain. Spain showed up in our model as an opportunity to buy or overweight on October the 17th. It's outperformed SPY by 26% since then. November 22nd was when it finally changed trends, but we were in down here on October 17th. It's risen by 41% outright. So that's another way that we try to find outperformance in different types of environments. So all I'm doing here, lastly, is I put all these ideas down, give them some bullet points so we can kind of take all this information and tick it together, group it together, and see what we have. In terms of market internals, our Asbury 6 positive as of March 29th. That means the market is internally healthy enough to be putting more money to work. Tactical direction, our CPM model, the correction protection model, risk on as of March the 31st. That's more of a definitive, at least it is for me, when CPM is risk on, I'm putting money to work. I'm putting money in the model and I'm looking for opportunities to overweight the right parts of the market. Sector rotation, our CEF model is currently long or overweight technology and communication services, both which are typically risk-on sectors. Under domestic asset allocation, our CART model, which is cross-asset, is overweight growth and large cap. Both are outperforming well. And finally, globally, global asset allocation, the US versus the world model is overweight Western Europe generally, as I showed you earlier, including France and Spain. So that's kind of how we're looking at markets right now. We think we're on the verge of a potentially really good move to the upside. There's a lot of sideline money right now. And that sideline money at some point is going to have to start getting with the party. So I think if we push through this 4130, 4140 area that we're testing here, 4150, it's going to force more money in the game at some point. And so that's what we're looking at. Generally speaking, we think this is a low opportunity, a low risk and high opportunity place to be looking to put some money to work, especially in these strategic places. So thanks for listening. This is my approach to markets, trying to tie data, money moving around the board with what I can see and using my 40 plus years of experience of, knowing what trends look like, identifying patterns, identifying, risk reward situations, mixing them together and finding something that really takes the emotion out of trading and just allows us to try to, you listen to what's on TV and, you read the papers, but this is faster. This is more direct. This is going to get you into the proper places in the market while the guys in the suits on TV are hashing back and forth on what they think the Fed's going to do next month. So with that, I'm going to turn it back over to John. And if you have any questions, I'd be happy to answer those.
Hey, John, thanks for that. Looks like we do have a couple of questions. The first one is gold has had a good run as the US dollar dropped. Any thoughts on the US dollar tied to gold going forward?
Yes, actually, it's funny you asked that. What I do, everybody, a lot of times these linear correlations are just accepted in the marketplace and people really don't go to the extent of seeing what they look like now. Yesterday or the day before, I actually looked at the dollar. I looked at ETFs. I looked at UUP, which is the ETF for the dollar, one of probably several, versus GLD, which is gold. It's the ETF for gold. And I looked at the correlation. And while the correlation generally over time is inverse, as you would expect it to be, the correlation over the past 1 month, 3 month, 6 month periods, as I recall, I don't have it in front of me, it was sloppy. It was maybe 0.5, 0.4. It wasn't anything to that I would trade one because of what I saw in the other. So I still like gold here. I'm looking for gold to stabilize and break out. It's testing some resistance here. If you look at GLD, it's testing resistance from about a year back. We were long gold. I don't know if I have it available here. We bought gold miners, Ring, R-I-N-G, March 24th, I believe. So maybe about a month ago, we just got out of that trade 2 or 3 days ago. I think we took 9% outright and outperformed the S&P by 5 or 6% during that period. I think it's going higher, but when I put an idea on, and we put the idea on because we saw strong asset flows that were going into both Ring and GLD, and I have a profit, 9, 10, 11% profit, and we're up against some old highs. I'm not going to sit there and let it go back to where I only have 2 or 3% profit. I'm going to take the money. And then if we have a breakdown, I can always buy that idea again. So yes, I do like gold. We're waiting for a new entry point.
Gotcha. And the next question would be, do your models consider volatility or the VIX, which is at yearly lows?
The models don't, but I do. I don't have VIX built into any of our models, but I do look at the VIX. And what's interesting is typically if the stock market is in major downtrend, or if the market is weak, I'm going to actually pull up the VIX here so I can specifically speak to what I'm seeing here. Like back in February, that's what I'm looking for. So back in February, we got down to that sub 20, sub 19 area in the VIX. It was a top in the stock market. Same thing happened back in December. When the VIX got down there, going all the way back to August of last year, the VIX got down to sub 20 market top. You're not seeing that now. You're seeing the VIX lingering really since the beginning of the year. It's lingering with little exception. Obviously, we had a big spike in the VIX back the middle of March. But generally speaking, the VIX has been right on 20 for 3 or 4 months, and we haven't had a significant market top. I think that means something. I think it means the character of the market has changed. So now we're not in a bear market anymore. Now we're starting to shift into a positive market, and that's why you're seeing the VIX down there. I will get nervous if the VIX gets back up above 20. That will suggest to me that we can have a minor pullback in the market, but I think the VIX's ability to sit on that 20 area, 19 area for the better part of 4 months, and the market has been relatively resilient. I think that speaks to the character of the market changing towards one of an emerging strategic opportunity to buy stocks.
It makes a lot of sense. I think that's pretty much it for the questions that we have. If anybody has any more, feel free to throw them up on that Q&A. But outside of that, John, really appreciate you joining us this morning, especially for the first time. Much appreciated. And we will be having our next research briefing on May 19th. And so feel free to check out the www.capis.com. You can go to the research tab and get a overview of today's briefing. And we look forward to you joining us next month. Thank you very much.